This is Keith Shabby, your friend in the mortgage business, and today we're talking about FHA income and assets required. In order to qualify for an FHA loan, all income must be analyzed to ensure that it is sufficient to cover the mortgage and other obligations of the borrower. Also, the stability and likelihood of the income continuing must also be analyzed. Income from any source that cannot be verified is not stable or will not continue may not be used in calculating the borrower's income ratios. Debt ratios are the relationship between one's income and one's expenses. Ratios are generally expressed as two numbers like 29/41 or 29/41. These are standard FHA ratios. The first number, the 29, represents the relationship between the borrower's income and his new housing expense of principal, interest, taxes, insurance, and or HOAs. A borrower who makes $3,000 per month and has a housing expense of $870 a month would have a 29% top-end ratio. The other number of 41 represents the total monthly debt including the housing expense and all other debts such as credit cards, loans, child support, and etc. Thus in our example, the borrower that makes $3,000 per month and had a total expense of $1,230 a month would have a 41% bottom ratio. With the use of automated approvals, borrowers' ratios can exceed the guidelines above. Also, with compensating factors, a borrower may be able to exceed the ratios and guidelines. FHA does impose an arbitrary minimum length of time a borrower must have held employment to be eligible. However, the lender must verify the borrower's employment for the most recent 2 full years. If a borrower indicates he or she was in school or in the military during any of this time, the borrower must provide evidence supporting this such as a college transcript or discharge papers. The borrower must also explain any gaps in employment of a month or more. Allowances for seasonal employment, such as typical in the building industry, may be made. The lender or underwriter is just looking to show a steady source of consistent earnings. Borrowers with frequent job changes generally show a lack of stability. Also, large swings or changes in income will also lead an underwriter to question the stability of the income. A borrower who changes jobs frequently within the same line of work but continues to advance in income or benefits should be considered favorable. Though FHA doesn't require assets in the bank to close on your loan, each mortgage consultant might have you put a cushion in the bank of at least 2 months of all your expenses with a minimum of 2 months of mortgage payments. This is Keith Shabbat, your friend in the mortgage business. Have a great day.